I think if we're going to have anything like a mania phase, or never even my mania phase, if we're going to have any like a normal market cycle, we're nowhere near the top. As far as, cycles, I'm not a chartist. I don't really look at the wave theory and so on, but, I'm a fundamentalist and I look at the fundamentals and all the reasons why I said that this year I thought would be the year for gold. Like last year, my highest conviction trade was uranium. This year it's gold. And all those reasons are just now beginning to play out. I was in team hard landing. I was saying the labor market was going to crack. I was saying Fed was going to cut rates, and that was typically bullish for gold when the Fed goes into a rate cutting cycle because gold doesn't pay interest, all these things, well-established trends. And those are starting to happen now, as far as I'm concerned.
Industry players and analysts said physical demand for gold across key markets has tumbled as prices continue to rise, with some retail consumers opting to sell their holdings and book the profit. Market analysts are now projecting one-year targets between $2,900 and $3,200 per ounce, up from the current $2,650. Lobo Tiggre is the founder, CEO, and principal analyst who criticizes the idea of selling gold just because mainstream media mentions it. As a fundamentalist, he expresses that gold is far from reaching its peak as we experience a mania phase or even a typical market cycle. Tiggre discusses the rationale behind gold being the top investment choice for 2023, following uranium in 2022. According to Bank of America, gold has overtaken the euro to become the world's second-largest central bank reserve asset. With the central bank's gold buying spree over the last several years and the rapid rise in price in 2024, the yellow metal now makes up about 16% of total reserve assets, just ahead of the euro. With all factors in play, Tiggre remains confident that the fundamentals, such as a weakening labor market and potential Fed rate cuts, continue to support a bullish outlook for gold. International and domestic gold prices are at record high levels. This fresh surge in the price of the yellow metal has been driven mainly by the 50 basis points cut in interest rates announced by the U.S. Federal Reserve recently, and expectations of more cuts by the American Central Bank. While geopolitical events can cause short-term spikes in gold prices, Tiggre explains that these tend to correct afterward, reverting to the underlying trend. He foresees potential gold price consolidation after such spikes, but remains optimistic about its long-term upward trajectory. Now, we present the clips of Lobo Tiggre's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
If you're a contrarian, it's way too soon to say, oh, that's it. CNBC mentioned gold, I'm selling. But if you did that, if you sold every time one of these snarky guys on X or formerly Twitter said, oh, CNBC said something about gold, I'm selling, we would have sold at 1,500. We would have sold at 1,700. We would have sold at 1,900, right? Like we would have sold at, we wouldn't have any gold left by now. So, nobody should be taking investment advice from snarky guys on Twitter alone. But the point is, I think if we're going to have anything like a mania phase or never even my mania phase, if we're going to have any like a normal market cycle, we're nowhere near the top. As far as, cycles, I'm not a chartist. I don't really look at the wave theory and so on, but, I'm a fundamentalist and I look at the fundamentals and all the reasons why I said that this year I thought would be the year for gold. Like last year, my highest conviction trade was uranium. This year it's gold. And all those reasons are just now beginning to play out. I was in team hard landing. I was saying the labor market was going to crack. I was saying Fed was going to cut rates, and that typically bullish for gold when the Fed goes into a rate cutting cycle because gold doesn't pay interest, all these things, well-established trends. And those are starting to happen now, as far as I'm concerned. So that's what, remember I said there's two answers. So the one is the fundamentalist in me says, no, all the reasons why I'm bullish on gold, they're still in front of us and just now coming into play. And that's, going into that from $2,600, $2,700 gold is, I don't even want to say where that I've got gold bug mania. But the other paw though is not just that it's gone up so much, but when you get something that's not a normal market dynamic, basically an exogenous shock like a geopolitical thing, yeah, you'll see gold go jump in response to that, usually with the dollar, which breaks this idea that they have to be opposite. You'll see the safe haven demand will make people stampede into gold and the dollar at the same time. This happened last October when Hamas, did the horrific thing that it did. And it happened in the second invasion of Ukraine. It happened in the first invasion of Ukraine. It happened briefly in the Gulf Wars. But the thing about that is that it's short-lived. It's not just the end of the war brings the world back to normal. Some of these wars never end. It's sort of the end of the news cycle. It's as soon as something else starts capturing the headlines beyond, gosh, it's, war, then you'll see that start to fade. And here's the thing. This isn't necessarily a bearish argument. Listen to me carefully, dear audience. I'm not saying that as soon as the war headlines cool, that gold will go down. I'm saying that in these kinds of things, we always see gold spike when there's a geopolitical event like that, and then it reverts to trend. So if the trend was upwards before, you'll get ahead of it, and then it'll come back down to meet that trend, and it'll continue unless something else changes on the fundamentals. And if the trend is downwards, then it'll spike up, and then it'll go lower, back down. It'll meet that trend again. So a clear example of this is, as I recall, is both of the invasions of Ukraine by Russia. So in this context, it was trending upwards. We get a big spike on the war scare, gets ahead of itself maybe. So some correction and consolidation after one of these spikes is not just normal. I think it's almost de rigueur. I don't have the math to tell you it's 100%, but it feels like that. From my experience, it seems like every time you get a spike on some really scary geopolitical news, it will correct, but then it reverts to trend. So I'm not making a bearish case. I am saying that as bullish as I am for everything else I just said, I can see space for gold to correct in the near term.
Market analysts, including Lobo Tiggre, predict that labor market cracks are becoming more visible, contradicting the Fed's optimistic stance. He expresses that the 50 basis point rate cut is a sign that the Fed knows things are worse than they admit, as their actions don't align with their words. On September 18th, the Federal Reserve announced a 50 basis point interest rate cut, marking the first cut in 4 years and likely the last major policy action before the presidential election on November 5th. Financial experts and everyday citizens eagerly anticipated this pivotal decision, which seemed to serve as a proxy signal for the state of inflation, a pressing issue for many voters. The U.S. economy seems poised for a continued slowdown in inflation that will allow the Federal Reserve to cut its benchmark interest rate and over time reach a level that is no longer holding back activity, Fed Chair Jerome Powell said on Monday, in remarks that showed no obvious lean towards a faster or slower pace of rate reductions. Ultimately, Tiggre is skeptical of Jerome Powell's assurances that the economy is fine and believes inflation is far from over. Let's get back to the interview.
People are admitting now that there are cracks in the labor market, that it's weakening, that they're admitting it now means that it started before. And they really started in July. The cracks started appearing in the labor market in July. And the cracks they're admitting now, is not new cracks. This is widening of the cracks, exacerbated by the almost million jobs, those famous 818,000 jobs that just disappeared in the first revision. By the way, that's not the last revision. We'll see those numbers. So, the fact that this is starting to happen is becoming obvious to everybody now. But at the time when the Fed was meeting, they weren't admitting any of this. They were still saying everything's fine. In fact, Powell is still saying everything is fine. So given that it hadn't become as undeniable a trend as I think it is now, I was thinking they'd probably go with 25, because why spook the markets? And according to what they're saying, they don't need to do anything bigger. So I think that their action actually contradicted what they were saying. They were saying all along, everything's fine. We're on a nice glide path, basically saying, we're going to stick this soft landing without saying it in so many words. In my mind, the 50 completely contradicts that. There's no way that those two actions make sense together. I mean, we call that a jumbo cut for a reason. It's a double cut. You don't do that without some good reason. And if the excuse is, we're just normalizing, the restrictive is now down, R-star. Well, if that's true, and you're just trying to get to a normal level, non-restrictive level, well, why not go a point? The estimate is for well below where we still are. So if everything is so wonderful, we could just cut to R-star or our guess of that. Why not just do it all at once? But no. So in my view, their actions speak louder than words. Their actions tell me that they saw more trouble than they're admitting. And even now, Powell at NAB yesterday saying everything's fine, everything's fine. I don't buy it. I don't believe it. I suspect that if he isn't flat out lying, then he's had too much of that Kool-Aid and he's too programmed to see it. But I suspect that I can't prove, I'm not a mind reader. I don't want to make bold statements like one presidential candidate who's famous for them. I just want to say that I don't see how a fairly intelligent, well-informed human being, as Powell appears to be, could possibly not know, not see what is so obvious to everybody else, that there is trouble out there. So, but his job isn't to tell the truth. His job is to steer the ship of state in wherever he thinks it should go. So I think that's what's going on. I think the Fed is just trying to manage expectations and confidence, because that's what mainstream economics thinks they should do. I framed all this in terms of mainstream economics because, if I was a mainstream economist and I believed what Powell believed, at 25 would have made sense. But I'm not a mainstream economist. I actually think that they should, if the Fed has any role with rates at all, they should still be higher for longer. I still think inflation's not dead yet. I think, the recession won't necessarily create the deflation everybody's expecting, especially if Lynn Alden, I don't know if you've interviewed her and talked about fiscal dominance, but if she's right about all the other money coming from Washington, swamping out the Fed's efforts with monetary policy, then, that is serious concern. Both parties are promising a chicken in every pot, the moon, the stars, everything else. So for the Fed to be cutting in front of that, I think is inviting the inflation genie back out of the bottle. So I'm not a mainstream economist. If I was in Powell's shoes, I'd quit, but I'd try to pull the plug on the Fed before I did. I'd try to abolish the Fed, audit Fort Knox, all those wonderful things if I had the chance. But sorry, long-winded answer because it's kind of complicated. But the takeaways here, I think the more important point, if you remember nothing else of what I said about the Fed, is I think the 50 is a tacit admission that not all is well in Mudville. They know it, and they're trying to get less behind the curve. I don't know that they can get ahead of the curve, but they know they're behind the curve, and they're trying to get out from behind it.
Analysts hope that another crucial category of demand, physically backed gold exchange-traded funds, will see more activity in the coming months, but their inflows are relatively modest for now. Do you think the growing demand for gold as a reserve asset will continue to drive its price higher, or could we see a shift in market sentiment toward other investment forms? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.